Welcome back. It's time for three-stock lunch. Financial stocks are heading into earnings season in pretty bad shape. A handful of big bank names, asset managers, and regionals are all trading at or near 52-week lows, but there are some exceptions. Let's trade the sector with Todd Gordon, founder of New Age Wealth Advisors and a CNBC contributor. Todd, great to see you. Let's start with the majors. You're eyeing Goldman Sachs.
Yep. Yeah, I like Goldman and just generally, Morgan, the financials, they're expected to show a big EPS drop, like 14% compared to last quarter of last year, Q3 of last year. But yet the sector in general is showing strength. So specifically, I like capital markets, Goldman, as you mentioned. They beat expectations like three of the last four reports on average about 20%. They're cheap. They're only trading 8 times forward earnings. They're expected to make about $37 total in 2023. A lot of volatility in the major asset classes, obviously, aside from equities, FX, fixed income, and commodities, a big trading shop. And they're trying to restructure as a one-stop shop. There's a lot of fallout with this Marcus robot investor. They're trying to go after the consumer in terms of that wealth management. They have a private equity business, ACO, which takes care of CEOs of some 500 businesses. So they've got to have an embedded wealth management to get into that if Solomon wants to try to go after that. So plus, it just continues to show relative strength compared to financials and relative to the broader market. So I hold Goldman personally and in my wealth management business.
Let's move on to the asset managers. You got BlackRock reporting tomorrow, but you're looking at Ameriprise.
Yeah, I like Ameriprise, Tyler. You just technically speaking, you look at the stock, financials put in a low right around July, where the broader markets put one in June. Ameriprise is 21% above that July high, so a ton of relative strength. The XLF financials right at it, and the SPYs, is below it. So they have over $1 trillion in assets. So they're one of the largest branded advisors out there. A lot of their revenues come from, 80% come from wealth management, asset management. They're acquiring a lot of shops, which helps their margins because obviously just more assets with the same cost basis is good. They've done a ton of buybacks. They've decreased the amount of shares outstanding by 50% in the last 10 years. They're trading 11 times forward earnings. Their price to free cash flow is only 7.5. It's well below the industry average. And BlackRock, as you mentioned, Tyler, I think they're like 12 price to free cash flow. And they have a very good, just the financials are just compelling and cheap valuation. Again, relative strength. I like AMP.
All right, final name, PNC, hitting a new 52-week low in today's session. What do you think of the regionals?
Yeah, I don't see a big reason to own regionals compared to large cap banks. There's not a lot of outperformance where there traditionally is, so I don't see the risk, the reason to hold that. PNC, I did cut this one. I held this in my portfolio. I cut it in May. They're right at the those lows that I mentioned, those July lows, so showing a lot of relative weakness. It's got a 4% yield, given, so it's hard to argue against that. They're looking to make about $3.50 to $4 a share. And there's concern about commercial and industrial loans and the possibility of loan write-offs. So loan defaults from private equity firms. They have exposure there. So I got to watch the report there. And they also have a lot of consumer cash on deposit, which I think is going to leave possibly and look for a higher yield than what the banks are paying us, which is not very much. So there's risk there. Watch that in the report.
Yeah, I mean, that's such a key point. It's pretty incredible that they're not paying more out to their consumers. Todd Gordon, thank you.